Hello, hi, morning everyone. Okay, welcome to our weekly webinar call. Right, today we'll be presenting on some of the earnings results for some of the stocks under our coverage, and then we'll move on to the main topic, which is initiation on CDL, which will be presented by my colleague Lucas Tan. Okay. First we'll start on the fourth quarter earnings review for Moneymax financials. Moneymax reported a lower net profit for the full year at 1.8 million, and this is mainly due to the higher cost expenses in conjunction with IPO, and also with higher rental expenses from the new retail outlets launched. Okay, as of this beginning of 2014, they have recently launched 3 new outlets, right? So, and how this done is the pawnbrokers will have to rent out the space for the outlets and have to apply for the pawnbrokers license before they are able to launch the outlet. So hence there's incurrence of rental expenses in a few months in advance. So the decline in revenue about 13% year on year. This is mainly due to the lower retail and trading revenue, which is impacted by lower gold prices and also management's decision to accumulate the inventory of pre-owned jewelry and watches in its retail outlets. So this is mainly to boost the retail activity over the trading of pre-owned jewelry and watches, as retail yields higher margin. Okay. For the financial year 2013, a final dividend of 0.3 cents per share was declared, and this represents a 54% payout. Management guided that the payout is on a conservative level, and we expect that the future payout to remain at similar level as the group will continue to focus on further retail outlet expansion. So we are still positive on the pawnbroking as well as the retail segments for Moneymax, as the despite lower gold prices, the pawn shop pledges is still on the rise, which indicates increasing activity for the pawnbroking business. We are maintaining a buy rating with a revised target price of 40.5 cents in view of better earnings ahead after tapering of the advertising and promotion expenses for 2013. Right, and also due to the positive outlook on both the retail and the pawnbroking segments. This hopefully will see a sustained recovery in the gold prices, which will help to boost the business. Okay. So next I'll hand over on the earnings review for the offshore marine.
Hi, for the offshore marine sector, Sembcorp Marine announced its 4Q results. It has core earnings of $553 million for FY13, which is 6% above our estimates and 5% above consensus estimates, thanks to its better than expected 4Q revenue. This is mainly driven by the initiation recognition of 4 rigs, particularly the second drill ship, second accommodation semi-sub, and 2 proprietary Pacific class jackups. 4Q 13 operating margins rose to 11.1% from 10.1% in 3Q, due to the deliveries of 3 jackup rigs in our view. However, margins were still below market expectation of 12.9%, while its order book remains robust at $12.3 billion with earnings visibility up to 2019. We are still cautious going forward in the near term because of the fact that Sembcorp Marine is still have yet to execute its drill ship over at its new yard in Brazil itself. We maintain a neutral rating for Sembcorp Marine with a target price of $4.29. As for the commodity sector, Wilmar also announced its earnings last week. Its FY13 core earnings is $1.3 billion, which is in line with our estimate of $1.3 billion as well. Thanks to its profitability improvement over in oilseed and greens, consumer products, as well as robust earning over in palm and lauric sector. This was partially offset by the plantations division due to the lower CPO price. Star performer for the group itself is oilseed and green division. Margins jumped by 128% year-on-year to $20 per metric ton, and we see volume growth over in 2013 as well, at a rate of 10%. Palm and lauric's division, we see margins remaining robust at a healthy level of $30 per metric ton, despite the additional refining capacity over in Indonesia itself. This is mainly due to the contributions from high value-added downstream products such as biodiesel and oleochemical. We continue to like Wilmar for its integrated business model and long-term fundamentals, as well as its strong exposure over in the attractive markets like China, India, and Indonesia. We maintain a cumulative rating at a target price of 388. For First Resources, which we initiated last month, we also see better than expected FY13 core earnings results. Core earnings reached $217 million, which is 9% above our estimates and 7% above consensus estimates. This is mainly due to the higher than expected sales volume, which is partially offset by the lower refinery average selling price. FY13 CPO production was up 12% year-on-year, despite the biological downtrend, which we see over in the industry itself. CPO peers like Gonagri and Wilmar actually sees a decrease in the CPO and FFB production, but for First Resources, we actually see a CPO increase. So this is a positive sign. We continue to see CPO production to grow over the next 2 years, supported by FFB yield recovery as well as new areas entering maturity. Management had guided for a lower CPO cost of production in FY14 due to the Indonesian rupiah depreciation as well as softer fertilizer costs, which will in turn offset the annual increase in the labor costs. For First Resources, the cost of production is still the lowest within the industry itself. We continue to like First Resources for its young plantation, low CPO production cost, as well as its undemanding valuation of less than 10 times FY16 PE. We maintain a cumulative rating. Thank you.
Alright, this is Lucas here. I shall take over from here. My colleague Caroline is not around, so yep. For the updates on Hobby OUE, I'll be just going through it for her. Hobby reported FY13 PATMI at 592 million, largely attributed to rebel gains and from Metropolis and also disposal gains from Chongpang Holdings. In terms of their core operating, property development dropped 75% from 450.7 to 113.6 million this year. I think this is kind of expected due to the slower luxurious residential sales. For investment income, property investment income, income increased from 135% to 25.7 million. So contribution is largely from the completion of Metropolis and what it brought up the overall property investment income. So and also Rose Court, which was acquired in mid-2013. Going forward, we believe that rental income will improve and be the lead earnings contributor in 2014. All right. Previously, 90% unsold units from Turquoise and Seascape have applied for the license, and now they are placed under investment properties. They are being leased out, and leasing activities for the completed Cape Royal is in progress. So, Metropolis and Rose Court will contribute 65% of our FY14 revenue forecast, and we are optimistic on the earnings growth. potential due to positive local office outlook and positive rental reversion upon lease renewal for Roscott in 2018. So stocks remain attractive in our view. For Amara Holdings, we still have a buy call. Current price is 52 cents. Our target price is revised to 70 cents. Revenue at 80.7 million is 11% lower from 90.3 in FY12, and PATMI is 27.2 mil, which is a 7% drop. The large with the higher rental income from RM mitigating underperformance from the residential and the hotel segment. The first and final dividend of 1 cent was proposed. Looking to FY14, we expect the hotel business of Amara to remain resilient, even though there's competition from surroundings. The management will continue its refurbishment of hotel to maintain its positioning with the new players. So we are looking forward to the contribution from Amara Bangkok, which will complete middle of this year, and Amara Shanghai, which will complete in the year 2015 year end. So stocks remain undervalued in our view. For OUE Limited, the FY13 revenue at 436.6 million, with higher property revenue recognition and contribution from US Bank Tower. Higher operating expenses, net fair value loss of 76.8 million from their investment properties, and loss on disposal of the 2 China hotels hit PATMI, and therefore resulted in a net loss of 36.6 million, which is below our expectation. Excluding non-cash item, PATMI was positive 40.2 million. Next in place is the 146 distribution of OUEH charge, which shall be credited on 31st March 2014 with the book closure date of 20th March 2014. OUE will reduce its stake in OUEH Trust to 33.3% after this distribution. A final dividend of 2 cents per share is proposed, bringing FY13 dividend to 23 cents. Looking past FY13, OUE now holds a strong cash position of 730 million and expect proceeds from list of estimated 300 million from listing of their commercial REIT. We expect OUE to announce new acquisition plans and asset enhancement initiative for US Bank Tower in the near term. So share price is muted currently as of now, but we believe in potential price upside upon a clearer view of capital deployment plans. Alright, okay, we have come to the main part of today's presentation. The report is out today. I, as in me or whatever it is, have just initiated on Capital City Development Limited with an accumulate call, and I'll be going through this in the next few slides. Alright, the company snapshot. Current price as of Friday market close is $9.39. 52 weeks range between 8.6 to 11.6. So market cap, current market cap is about 8.5 B thereabouts, and based on our valuation is trading at about 41% discount to RNAV. Just to give you guys a brief background, they are engaged in their business is kind of split into 3 segments. The first is property development. This is more of your development and sales of all your condo units, your apartments, and yep. The next component is hotel operations. This is largely through their listed subsidiaries of Millennium Corp Hotel PLC. So this subsidiary manage about 105 hotel assets. Yep. The next and the last one is rental properties. This is kind of like whatever is remaining, all the properties that's in their balance sheet, and it spans all the subsectors including industrial, office, and retail. So a key point to highlight for the internal company background is that they have recently hired a new CEO, Grant Kelly, and he's a former head of Apollo Asia Real Estate for Apollo Global Management. So this position, he's holding the position of CEO, and this position is a new position in the company. And they come up. The reason why they actually hired him is more for the sake for diversification. They want him to actually look at opportunities from other parts of the world and start to look at for opportunities there. And the end result is obviously the fact that he is supposed to secure value accretive investment deals for them. Yep. So his previously he was in private equity real estate fund management, and we believe that such experience will be good for him and the purpose of why he's at CDR right now. So for the land bank, based on land area, residential still take up majority of their land bank with about 946,000 square feet in local and overseas is kind of at similar levels as well. In terms of commercial and hotel, is still kind of on the low side, and it's about 193 and 294,000 for local and overseas in terms of their commercial and hotel land bank. All right. For residential, I think that this is kind of quite publicly available. The information on such is quite publicly available. For them, they target the ultra luxury, and affordable luxury. In more recent times, you can see their focus shifting more towards affordable luxury, which is kind of the mass market, the genuine demand for owners occupied demand. Ultra luxury, they have currently launching 3 to 4 projects, and luxury is maybe between 5 to 6 projects. Yep. For hotel, largely is through their subsidiary Millennium Hotel and Copthorne. So for hotel wise, they are currently Millennium and Copthorne, they are still going through quite a few AEIs for some of their hotel assets, and largely this is kind of the resilient part of their business because they are, in terms of geographic sense, they are very diversified. And lastly, commercial is split into office, retail, and industrial. There's another service apartments, but that is just like one asset. So, yep, it's kind of the small part of the business. Okay, so here just gives you guys a rough view. You can see that in terms of geographic spread, their business is spread across majority of the other continents. The heavy focus for hotels will be in New Zealand, in Asia, and also in the US, and in the UK part of Europe. And as for residential, largely local, and they're currently now expanding to overseas in China. All right. So coming to the numbers, for our base case valuation, right on the left is kind of like a summary and also the assumptions that we have made in doing the valuation. In this valuation, as per all developers, we use an asset-based valuation, and we actually value it to RNAV. The assumptions made for RNAV for residential will be that for their pre-sold projects is kind of cast in stone. If we are using historic price to forecast to do their future cash flow. For unsold inventory, okay, we actually pricing it that the sale will eventually be done about 15% lower than current market residential prices. For the land bank that's yet to be sold, okay, we believe that after development, the residential units will be sold at about 10% lower to current market prices. For hotels, the way we value it is by looking at market comparables and on a per room basis. So for office and retail, is largely similar. You are looking at market comparables or through cap rates, forecasted cap rates in the 12 months horizon. All right. Looking at after we come up with this valuation, okay, you can see for on the top left-hand corner, okay, this is our estimates, the gross asset values. All right. On the component, we can see that the Singapore residential and the office, okay, take up the large part of the valuation. Okay, hotels, okay, take up about 19%. We differ quite a fair bit from other houses because we actually look at all the individual hotels and try to arrive at this a more updated value as compared to just taking the listed subsidiary market cap and then inputting into our model. We actually do the valuation for individual assets for MNC. So in that sense, our hotel, okay, it takes up about 19% of our gross asset values. Looking at, you also want to get a flavor of in terms of like earnings and in terms of like the top line, okay, how are they contributing? It's actually on the top right hand corner. For this FY13, okay, you can see hotel operations came in at 49% in terms of revenue contribution, and the property development arm will contribute 38% here. These two will be the largest contribution, make the largest contribution in FY13. So this is the historical. You can see that for a large part, okay, it is still property development and hotel operations that will contribute to the top line the most, with rental properties coming in third at a mere 10 to 11% usually. Right, for going forward, if we foresee that this trend doesn't really change, okay, hotel operations will remain resilient, and that because they are largely diversified. Anything that happen in based on region-wise, if Asia region for the hotels were to have show dismal results, the other region will actually outperform and kind of like mitigate this. This has always been a story year in year out. So for hotels, the red bar, all right, kind of going to remain resilient. So for property development, we also believe that there will be some growth. This is based on previously sold units. What has came in, we are just forecasting it forward. So yeah, you can see that there will be about 2 to 3% growth in terms of the property development side. For rental properties, this is a rough breakdown. Okay, sorry. Yeah. So for rental properties, the large part came from office, and for the most part, it came from the local office assets. Right. The second one would be retail coming in, and the industrial and the others is kind of quite negligible. So looking at what affects their value, this is for residential market. We believe that for residential market, there will be policy risk. In terms of they are under the QC and not under the CCD, something that I will clarify later. And we believe that the developer sales price for residential units will also be a large factor in the share price performance, and obviously the market demand, which is kind of like the third and fourth point are kind of similar. In terms of office and retail, we believe that the main factor will actually be the specific country macroeconomics. And for hotel, we believe that it's more of a global financial situation that will determine their performance. And lastly, for the company as a whole, we believe that the interest rate, the current net debt, and whether they have any available debt headroom will be the driving factors behind their performance going forward. So for residential outlook, okay, briefly, policy risk. From the previous presentation, I actually did talk about all the different policy, and I did mention that we are expecting the government to fine-tune the policy. We believe that the government is currently having a very watchful eye over the property market, and if the market were to have prices for residential units, if there will be any further increase, the government will tighten. And similarly, if the price were to drop drastically, the government will actually ease up on the policy measures. So the quote from the budget speech is that the government will continue to monitor the property market and adjust their measures when necessary. So we believe that this is a sign that, at current levels, we do not see further correction of the property prices due to policy risk going forward. So the CDL chairman, Mr. Kwek Leng Beng, also believed that the local government will relax their policies when the transaction volume and the price dips. So, so that's the update for the policy side. I do get a lot of questions on whether CDLs and other developers in Singapore, whether they had to apply for the qualifying certificate for their projects, for their development projects, and whether they need or need not do. Just to give you guys a bit of a flavor. Okay, qualifying certificate applies to any developers, okay, that have shareholders or owners that are from overseas, and there are other factors to determine whether you should apply for it as well, but this is largely the determining factor. For the local developers, whereby all your shareholders or your owners are only from Singapore or are Singapore residents, okay, they apply for this thing called clearance certificate. And as for those with overseas owners or shareholders, they have to apply for qualifying certificate. So for the most part, okay, all the listed developers are and should be under the qualifying certificate for all their projects. So under this QC, there's a rule that they have to develop the land within 5 years of getting it, and apply for TOP, and they need to basically sell all the units within 2 years after TOP. And if there's any violation to this, okay, they have to pay a penalty, or they have to apply for extension charges. So for CDL, those properties whereby they are unable to achieve this mark, they have already applied for extension charges and is largely taken care of. So there's really no cause of concern. But just a clarifying point, they are under the QC. So in terms of residential market outlook, the top left-hand corner, this is the capital value. The capital value are the value that is for the properties in the market right now. It's an estimation based on this is a data coming from URA, and it determines the transactional price. It's a mix of the transactional price, the current developer sales price, and whatnot. For the rental value, this is self-explanatory. For the stocks and available units, you can still see there is a very huge increasing trend ever since the Singapore firm up. Okay, there's only an increasing trend. In terms of vacancy, we are still at a very healthy about 7% for non-landed, and for landed is an all-time low of about 3.8%. In terms of supply, you can see that the supply has come off a fair bit in 2013 as new units are completed. Alright, but I think that we should more focus on the last diagram here. The last diagram here is our estimates of what is coming to the market in 2014, 2015, and 2016. We look at all the developers, their backlog, the unsold inventory, and the land bank that is being sold by the government, and we all lump it up to one aggregate figure. For 2014, okay, you can expect about 40 plus thousand coming to the market. And for 2015 and 16, there's about 60, between 65 to 70,000. And for 2016, we have 64,000 that's coming to the market. In arriving at these, okay, we do understand that if the market is unable to absorb, then developers will basically resort to extending the sales period. They'll try to drag out the sales launches over a longer time frame. So we do not expect this to come. We do not expect this diagram to come true to a T, but for a large part, it's a very good indicator of what's coming to the market. In terms of demand, we took into account like the population growth. We took into account the fact that the market have a preference for lesser individuals within each housing unit. And we also look at various other factors to derive our demand. And we came to a demand of maybe 27,000 physical demand for the units. And for 2015, it's about 30 odd. And for 2016, it will dip back to 20,000 plus. So having said that, you can see that largely it's an overhung supply situation, and that we do not believe that the market demand will be able to absorb what's the market supply. So this is kind of it doesn't really bode too well for the residential market, and we believe that in terms of the sales price, it will still come down. So we are actually expecting a 10% pull down correction in the residential price, further correction in the residential prices. So for the office market outlook, you can see that capital value is still on the rise. Rental value is kind of holding stable. We are generally quite positive on the office outlook. We believe that going forward, the capital value will still have to play a bit of a catch up, okay, because the rental value has been held at historically high levels ever since the recovery from 2009. In terms of supply, for a large part, the majority of suppliers came to the market. We believe that the current supply situation will still hold. And the only big project that's coming up will be the South Beach, which will only be coming up maybe, as in leasing is undergoing leasing right now, but it will come up, I think, by the end of the year. Yep. In terms of vacancy, it's still a healthy rate of between 10 to 12%. Okay, the last point of what will affect the share price interest rate. For a large part, we do believe that the interest rate will rise in the near term, over the next 6 to 8 quarters. We definitely will see the interest rate moving upwards. However, for CDL, currently a net gearing ratio is at about 20%, so which is really the historic low. So we do not believe that this interest rate is going to impact that much on their valuation. Yep. All right. So this is our base case valuation. I have explained to you how we go about doing the RNAV valuation. So in terms of investment merits, we believe that there's undemanding valuation. It's trading at 41% discount to RNAV, and our target price for it is at 11.16. Secondly, in terms of the price to book ratio, is at 1.07 times. It's the lowest since 2010 year FY 2010. So a point to note right here is the CDL balance sheet exclude revaluation gains. So what does this mean? It means that their asset values, okay, that's inside their balance sheet is not inflated like the other developers who every year they send their properties for valuation and then they will include a revaluation gain. And the asset books kind of fluctuate from year to year. For CDL balance sheet, the assets are held at cost less impairment charges. In other words, it only goes downwards, it doesn't go upwards. So we feel that in a way this is understated. And the fact that the price to book ratio is so low, it means that the company is undervalued as of this point in time. For residential, we believe that they have very locked-in profits from previously sold projects. So for the next 2 to 3 years, you can see that their residential revenue and in terms of income, in terms of earnings, okay, will kind of be stable with a slight increase in year 2015. For hotels, we expect strong earnings from this hotel segment, okay, as more and more of the assets who are previously under renovation and under the asset enhancement initiative, okay, will be completed. So we believe that right now the market is kind of volatile, that there are many factors that's affecting it, and we just kind of want to identify such factors and look at their impact on the valuation. So in that sense, okay, I came up with the three main scenarios that could happen, and we just want to identify this with you guys so that you guys have an idea of how these things will affect them. So for the first scenario, if the property market were to stabilize and the government would say, okay, right, this is the price that we want to keep the residential units at, so they were able to ease up, okay. So we assume that the current residential sales price stays and that they are able to sell it at current day prices instead of the base case of 10% correction. So the impact on RNAV is that RNAV will rise to 16.44, and our target price instead of 11.16 will be 11.51. This is if, okay, the residential sales price would maintain at current levels. The second scenario is that there may be a potential upside, okay, in terms of like new CEO. Here they have strong balance sheet, they have a huge cash balance, and there's low net gearing. So if they were to start to borrow money and they will start to use whatever cash that they have to enter new deals, go into new development projects, acquire new assets, okay, we believe that it will mean that the valuation will be increased. So our RNAV for this is about 16.58, and the target price will be 11.61 if this happens. The assumption here is that they are able to fully utilize their cash of 2.8 billion, okay, to acquire projects that can give them that is value accretive in a region of about 10% margin, 10 to 12% margin. The third positive and the last positive scenario, it may be there may be a potential increase in office rentals. We believe that we are quite positive on this front, and if let's say there will be a strong demand for office space and the office rental would rise, the impact on valuation will be that the target price will be raised to 11.36. Alright, so I'm quite sure if you look at the upside, there may be a downside to this company. The first scenario will be that, yep, the sale price for residential units decreased more than 10% from the 4Q13 levels, which is our base case. And that the government have a delayed reaction or non-existent reaction in terms of like easing out on the policy. That means they just let the policy play out and they do not go easier on the market. So if they were to correct beyond the 10%, all the way back to the FY09, the lows of FY09 levels, okay, the RNAV will be 14.48, and our target price will be $10.14 for the company as a whole. The second scenario that may happen will be that there may be weakness in global hospitality in terms of like previously like the SARS, or maybe there's a pandemic that's going on. We believe that will actually adversely affect the hospitality segment, and if it will be prolonged, or as in the market may no longer attach such a high value to their hotels, the RNAV will drop to about 14.93, and the target price will be at $10.45. And the third scenario that may happen will be macroeconomic risk in terms of tapering. If the US were to not handle it too well, and the whole economy were to go back to it being shaky, that the market may no longer value their shares at a premium. Okay, what will happen? We are looking at the potential effects of this. So we believe that the market will no longer assign a 30% discount to RNAV, and then the market may even drop the valuation of it to about 47%, which is 2 standard deviation lower than the historic average. So if that will be the case, although the RNAV stays at 15.95, the target price will be lowered to about $8.45, which is the only loss scenario that we are looking at. So coming to the end of my presentation, okay, we are looking at the possibility that if all goes well or if everything goes wrong for them. So in terms, is there a fairy tale ending to CTL? If all the positive events were to happen, what would their valuation be? So we believe that if that's the case, the valuation RNAV will be at $7.35, and the target price will be $12.14, which is kind of like the best case scenario. And this price is last achieved maybe about in the January 2013, which is the start of last year. Okay, that the price is at these levels, but it has since came down quite a fair bit. In terms of what will happen if all the bad things will happen, there's a global economic crisis again, and that the various sectors underperform. Okay, we believe that the share price may drop to as low as $7.14, and this will actually present quite we do not think that this will likely happen. based on current market situation, but we do acknowledge that it is a possibility. Yep. So in conclusion, investment merits as a recap, okay, is firstly, this company is undervalued, and that we believe that the residential sector have seen the worst, and that there will be a stabilization of residential sector, which means that the sales price for developer housing units will hold at current levels. In terms of the balance sheet, there's a strong balance sheet, and we believe that this will lead, and the huge cash power will lead to more value equity projects, and there will be an increase in office rental rates. The risk is coming from policy tightening and macroeconomic risk. Once again, we do believe that the worst is over, and that we do think that in terms of investment merits, positive events, okay, are more likely to happen than negative events right now. So, yep, the target price is 11.16, and the premium over current price is about 18.9%. Factoring in the potential, the dividends forecast of about another 16 cents, you're looking at about 20% upside. Yep. With that, I've come to the end. So, yeah, is there any questions? No questions? Yep. Hi, I'm still around. Yep. Is there any question you guys can type into the question window on the right?
Hi, it's Joshua here, the head of research. Very strangely, questions are not coming in. Usually we get a flood of questions. Hi, we have some questions on the Russian-Ukraine war. Yes, it is affecting all markets now. I suppose Russia's interest in the Crimea is pretty strategic. Traditionally, that part of Ukraine has always claimed to be part of Russia anyway, and it was dubiously given to Ukraine by Khrushchev many years ago. So that side of Ukraine has always felt that it belongs to Russia. I suppose in this day and age, it's quite unlikely that Russia and NATO would go to war. But then, of course, you can never say, because Russia does feel that it's being hemmed in by NATO, and NATO is and the European Union are trying to woo Ukraine, right? And if Ukraine joins them, then that means Russia will basically have NATO at its doorstep, which it will not want. So that could spiral out of control, I suppose. Currently, we hope that there will not be a war. If there's a war, I'm pretty sure markets will sell off. But I suppose, we should not panic because there's still plenty of things, plenty of diplomacy that can go on before you actually reach that kind of point. Singapore counters affected. Off the top of my head, Food Empire has a big presence in the region. Russia, Kazakhstan, Ukraine, some other Eastern European states. It's a leading coffee brand. Its earnings report was not good anyway, so there was a huge sell-off, and I think the problems in that part of the region probably exacerbated it. Okay, the question, why does the market drop so much this morning? Yep, China's PMI was not great. It was still printed an expansion, but it's a very weak one. So China we have been flagging as a risk for a while. And so a poor print on the manufacturing side in China is dampening sentiment. However, we do note that on the services side, China registered an expansion. Okay, so I feel that it's still not a sign that China is going to have a hard landing, although the economy is weak, and it's something that we'll just have to live with over time. The market in general climbs a wall of worry, so this is just another worry. And of course, the possible flashpoint in the Crimean region in the Ukraine has sent the markets lower.
All right. Firstly, for question for CDL, is South Beach part of CDL? Yes, it's part of CDL. It's on their books and is currently held at cost. They do capitalize the construction expenses needed to bring to construct it, and yep, it's on their books. No, and they are not going to do any revaluation on it. They're going to hold it at cost, less impairment, if there is any impairment for it. All right. So, and the next question on CDL is, do they articulate their land bank replenishment? How do they replenish their land bank? Basically, I do not. They did not actually make mention as to how do they go about their acquisition of land banks, and they do not have any actual target on a year-on-year basis of how much land they must maintain and whatnot. But from the history of their land banks and how much backlog they do, okay, for residential, they normally create about anywhere between 3 to 4.5 years worth of property development projects, okay, as a backlog. So for that, on that front, we can roughly make a good guess as and when the development are completed or the sales launches are successful and it's fully sold, okay, the moment the cash comes in, they will start to look for different land plots to be held in their books. But having said that, they are now more going overseas to look for the land bank, especially in China, and they are aiming for the luxury homes. And the sites that are located are usually within the upmarket of Tier 1 cities or top of Tier 2 cities, definitely. So in that sense, this is the residential land bank strategy going forward. In terms of the other sectors, I don't think it's really that significant. Having said that, they do keep a lookout for such investment, and going forward, they may be. Sorry. Yeah, and also the fact that, for the other sectors, they do look at deals from time to time, but they are more often looking at acquisition whereby the asset is already being built for other sectors. Next question: do you think for the property sector will continue to face some pressures the whole of this year? The property sector, for the most part, has always been facing pressure ever since 2009. Yes, we do believe that they still face pressure as the government will try to uphold the property measures to maintain a more sustainable growth. They definitely do not want the residential prices to just run off by its own. So yes, we do believe that there are some pressures. But having said that, the government is all ready to ease up on the prices if the market were to tank, or as in the prices were to drop, just fall off the cliff. So and there's another question saying, what is Chairman's Mr. Quek's assessment of his new CEO? This question is really hard to answer. Did he explain why he has? But I think the next part is a very good question. Did he explain why he has appointed Mr. Graham Kelly? Yes, he has explained why he has employed Mr. Graham Kelly. The reason is that he believes that Graham Kelly will actually he will be opening the door to overseas investment. He will be able to secure the deals based on Graham Kelly's connection. Graham Kelly came from Apollo Global, which is kind of a big player in the Asia Pacific private equity real estate fund management business. They actually buy the actual his previous company is actually into investing the actual assets, real estate assets itself, bringing about a turnaround before divesting it. And he definitely have extensive connections to the deal flows from that front. So I believe that Mr. Quek actually carved a new position in a new position called the CEO. Previously, they do not have a CEO. He came up with this new position for him so that he actually tapped on the deal flow for the overseas projects. Yep. All right. The next question: Can we repeat? Can I repeat why City Development down limited? Okay, deal way. I'm so sorry. Can I don't really get the question? Maybe you can repeat it. Yep. The original question is, can I repeat City Development down limited deal way their value, their asset? So yeah, I do really, yeah. I hope that you can repeat your question.
Hi, good morning everyone. Benjamin here, who's covering the banking stocks. So I have a question currently on banking stocks in SG still buy at the current price, and which one comes out as a top choice. So just to reiterate our call on the three banking stocks, DBS and UOB still currently at accumulate. So the DBS and UOB's target price is $18.48 and UOB is $22.33. OCBC is still at a neutral at $10.17. So just take note that after the year-end results have come out, we have revised the previous target price slightly downwards, right, to reflect a more conservative outlook on the global front. However, the fundamentals of the banks are still very intact. Okay, so the fees and commission are still growing very strongly. Right, loans growth is expected to be a bit more moderate going to 2014. Right, so again, fundamentals of banks are still intact, and OCBC do exercise caution on it, as currently the market is still remaining quite focused on what's the outcome of their acquisition of Wing Hang Bank. Right, so for DBS and UOB, still very sound. Alright, so with the current sell down in the markets, this might present a quite good buying opportunity to look at, right, for these two banks. Thank you.
Right. I think that one of the listeners has already clarified the question. As in, to explain their downside is why is the downside limited due to the way they value their assets. Okay, it's not the way they value their assets, it's actually the accounting. How do they do their accounting? The think about it is, for them, okay, wherever they buy an asset, they actually record this asset at cost. Alright, and going forward year on year, at the end of every year, they look at whether there's any whether this asset is performing, and if there's any, if let's say the surveyors are value this asset at a lower price than their cost, they actually recognize an impairment value so that their asset books actually is actually lower than the cost. In other words, they only see how whether the assets has underperformed or not. So just take for example, if let's say they buy an asset at maybe $10 million, and at the end of the year, if the surveyors and after they put it up for valuation is only at $5 million, then they'll recognize $5 million in impairment, and basically the asset, okay, is now on their books at $5 million. On the flip side, okay, if let's say they were to buy the asset at $10 million and at the end of the year is valued at $15 million, okay, there is actually, in normal in other developers' books, they recognize this $5 million as revaluation gain, and their asset will be held at 15 million. But for CDL, they do not do that. They disclose the fact that there's a potential reval gain of $5 million, but the asset book is still held at cost of $10 million. So in other words, okay, their assets is understated. The true value of their assets, okay, are actually higher than what it is on their asset books. So in that sense, we believe that you are actually, if you were to look at the current day valuation, okay, that is actually much higher, and therefore it's not that the downside is limited, it's just that they understate. So in terms of the price to book is at 1.07, but the book value is actually the true value of the true book value is maybe a bit higher, and their price to the adjusted book value is less than 1.0. Yep. So I hope that that answers your question. So the next question that I have is more like a follow-up of South Beach within CDL. He's asking how do we value South Beach? Is it based on their rental return? All right, the South Beach is right now is still in part of construction. There's definitely no market comparables around the region is definitely not applicable because there's really no similar assets of which in near Suntec area whereby it's a mix between hotel, office, residential. So we split up this South Beach, okay, into the various different components, okay, and we use firstly the comparables and secondly in terms of the cap values, like net property income divided by cap value for that segment, and we sum the value for their residential, some value for the office, and then that of the hotel as well, to put it all together to get a gross asset value for South Beach. So there is no, as in like it's kind of like split up into different segments and it's valued in individual parts, and then it's put together. So I hope that answers your question of how we value South Beach. There's a follow-up question asking whether property developers, okay, have a choice as to whether they want to book in their reval gain and loss or loss in their balance sheet. In terms of impairment loss, no, there is no choice. They have to book it in to their balance sheet. In terms of revaluation gain, I think that that is optional for them. It's up to them, and the only catch to it is that they have to be consistent. For example, you cannot say that you want to book a reval gain for property A, but you do not want to do that for property B. Again, they have to be consistent in the sense that all the properties within the investment, for example, they have this line item in their accounting books called the investment properties. If they are going to recognize revaluation gain for that, all the assets have to recognize the revaluation gain. Or if they do not want to recognize that, then all the assets could not be recognized. All revaluation gain for the properties inside investment properties cannot be recognized. But in terms of impairment loss, they do not have an option. They have to recognize the impairment loss. Another follow-up question: does CDL have this choice forever to continue not accounting their properties at market value? I think I answered the question previously. Impairment is definitely the question cannot be answered in a yes/no manner. In terms of market value, like I said, if there's an impairment loss, they have to recognize it. In terms of revaluation gain, yes, they do have they are able to choose to not put it into their asset books, and therefore not recognizing the gains, but the loss must be recognized for sure. Alright, there's another question. This is more on the property market. Will Capital Mall also get the benefit of commercial/office rental profit like what you cover in CDL? We do have to understand that the properties for CDL, the office properties, are mainly in Singapore. In terms of Capital Mall, I think they do have a mix. But having said that, for a large part, yes, obviously the whole if we are quite positive on the office rental rates, and we do believe that there may be some upsides. We do hear from the big leasing agents, okay, and we do talk to them, and they are making mention that there are firms starting to ask for the different codes and whatnot. So yeah, they do get the benefit when the overall market rise. Anyone who's exposed to the Singapore local office market will get the benefit. Another question, is CDL the only property developer holding properties at cost? Okay, firstly, one thing to clarify, the properties is what they're holding at cost is the investment properties. Their residential properties is development. There's nothing, they're not holding on to it. They are just basically having a land bank, developing it and sell. So for investment properties, CDL, among the big developers, CDL is one of the few properties that actually hold it at cost. Yes, that's so. To a large extent, the answer is yes.
Hi, Ken here, the market analyst. Okay, I got some market questions here. Oops. The first question is regarding gold. Okay, let's see. The gold question. Sorry, give me a second. I'm just looking for the question. I know there was one on gold. Okay, so the question is basically the common knowledge that if there's a crisis, then gold should get some sort of bid, and what price should gold be expected? Now, from a technical point of view, let me tell you how I look at this. Okay, first of all, you got to realize that for our view, the longer term view for gold is such that as long as the U.S. Economy is doing well, then that's actually bearish for gold. Okay, because but at the same time, right, we look at this Ukraine news and we notice that actually the news came out on Friday, Thursday and Friday, and gold actually, the price of gold did not even get really a bid, even though the negative news has already out. So this tells me the probability of a spike in gold is not quite there unless things unravel really quickly. So that being said, I want to ask this question: what's the expected value for gold? Now, at this point, if you go along to gold, the risk reward is not quite in your favor. But if there is an unraveling as a crisis situation occurring, then I will say that if there is an upside break, then the target for gold would then be 1375. 1375 would be, I guess, high probability target if there's an upside bid for gold. However, I must say that at this time, the risk reward is not quite in your favor if you go long on gold, especially so since the news of the Ukraine crisis came in on Friday and gold did not get a bid. So it's a case where we try to distinguish between like a real crisis and what the media is trying to highlight to you, which may not necessarily be a true reflection of demand of gold. Next question. Yeah. Okay, there's a question that says, okay, will the market performance, I assume the market meaning STI, how will the STI performance be considering poor China PMI and US market overbought stage? Okay, to answer your question, actually for last week, I already had noted on the morning note that we are getting overbought, and at the same time, the stochastics is about to turn down. I mentioned that last week. So when I look at these news, this just kind of verifies the technical signal that the stochastic is turning down, which implies that this week could possibly be a weak or a flat week. Okay, so that's to answer your question.
Right. Still some follow-up question for real estate and CDL in particular. With the good outlook for office rental rates, what is your view on office REITs? For the REITs wise, it's true that if office rental were to have any upside, okay, that definitely it will flow over to the office REITs for sure. Having said that, we had to look at individual REITs valuation. I don't with the market being a bit shaky right now, I can't really for an overall. Okay, just to answer the question first before I go to to a bit more specifics. If outlook for rental, office rental is good, so definitely you do see that this is one of the factors that were also a driver for office REITs. So in that sense, in this particular aspect, we are positive for the office REITs. Having said that, okay, I do not really want to make a sweeping statement on all office REITs, saying that all of them are good. We have to look at their individual valuation, the management culture, and whether how well the office is located, and what our returns they are going to get. So, yep. So to answer the question, yep, the good outlook for office rental will be a positive factor in office REITs price movement. So, and then a follow-up question, which other property developers am I aware accounting their investment properties at cost? I can't really like list out a full list of all of them that are property at cost, but for the large part, okay, such information is actually readily available. Just pick up at their most recent annual report. Towards the end, there's always this part about notes on their financial report. They do, within the first few items, they do have to make mention of how do they do their accounting. Having said that, okay, for the large part, I would say that up to 80-90% of the developers and also the property investment holdings, trusts and whatnot, they usually account for their investment properties at market valuation. At the end of the year, they will have to put out the assets for the surveyors to value, and subsequently they'll add up that value and recognize any gains or loss. All the big developers, including Sealand, Keppel, including OUE, including the major players, they're all at market value. Yep. So, copy of our presentation material, I believe that we did send out in about maybe in this morning. But yeah, I do understand that I think there's more than 2 or 3 guys here who are saying that they don't have a copy of it, so I will have to resend it. So for those guys who are visiting it for a second time, I'm so sorry for having to resend it, but I just want to make sure that all you guys are actually getting the materials. All right. We have come to the end for this week's presentation. I'm Lucas Tan, and I believe that if you guys have any questions, you guys can just just drop me an email, and I'll be more than happy to clarify with you guys. So having said that, thank you guys for tuning in, and I hope you guys will tune in next week for our next presentation. It's a pleasure having you guys. Thank you. That's all for today.